Welcome to the Compliance 911 Show, a no-nonsense podcast discussing hot topics for today's busy compliance professional. It's everything you wanted to know about regulatory compliance, but we're afraid to ask. And now, here are your hosts, Dean Stockford of M&M Consulting and Len Suzio of Geodata Vision.
Len, it seems like it's been a while since we did our last podcast, but with the last two, including our special guest, followed by the annual compliance school, it seems like it's been a really, really, really long time.
Yeah, I feel the same way, Dean. It does seem like it's been a while, but I'm certain you're going to enlighten us with another hot topic today. What have you focused on for today's podcast?
Yeah, well, that's, of course, I think I've got another action pack. I probably should say a lot to unpack, but today I'm actually going to talk briefly about the FDIC advertising changes, which became effective actually in April 1st of 24, and will modernize the rules governing the use of the official FDIC sign, the insured depository institution advertising statements that they use to reflect how the depositors do business with those insured depository institutions, including through, the newer digital and mobile channels that we're experiencing today.
Well, in light of the recent publication by the FDIC of that rule, it's not only an interesting topic, it's definitely a timing topic. And, we focus a lot of energy on fair lending, CRA, and Section 1071 in the last few podcasts. So it would be a refreshing thing to pivot to something different.
Yeah, I agree. I think it is somewhat interesting. It's not overly complicated, in my opinion, but certainly interesting. I think a vast majority of the changes are fairly straightforward, and institutions, shouldn't delay thinking that it's really, really easy, but institutions should take steps to ensure that they are, in fact, compliant. In addition to the provisions regarding advertising and signage, the final rule also clarifies the FDIC's regulations regarding misrepresentations of deposit insurance coverage, which apply to any person, including those insured depository institutions and non-bank entities. The final rule actually addresses specific scenarios where consumers may be misled as to whether they are conducting business with one of those insured depository institutions and whether their funds are protected by FDIC insurance. And I will just say, Len, from experience, one of the big things that always came up were the relationships of financial institutions with the sale of brokerage or non-insured products and the commingling of those, and giving that impression perhaps that they are insured when in all actuality they're not insured products.
Mm-hmm. Yeah, well, that certainly is a big step by the FDIC to add some clarification, and by addressing specific scenarios where consumers may be misled as to whether they're dealing with IDIs and ascertain whether they're insured or not. Yeah,
no, correct. And, so I'll get a little bit more granular here, I guess to say, and let me jump into some of the specific changes for as you just alluded to, the IDIs, which are, stands for the insured depository institutions. So when we reference that, that's what we're referring to. But the rule itself modernizes the rules governing the display of the actual FDIC sign in branches and extends the application requirements to other physical premises where consumers actually have access or can transact deposits. In examples, cafe style. I know Capital One has a lot of what we call cafe style locations. So this obviously would impact that. It establishes and requires the display of the FDIC official digital sign on bank websites. So here we get into the mobile applications and, of course, automated teller machines and other like devices. It also requires the use of signs that differentiate insured deposits from non-insured products across all banking channels, and a disclosure that certain financial products are not insured by the FDIC, are not deposits, and may lose value. And again, that was more on the investment side, as I was referring to. And it requires a one-time per web session notification when a logged in bank customer leaves the insured depository institution's digital deposit taking channel, as an example, through a hyperlink to access non-deposit products or non-bank third parties' website. So if I had an investment arm at the bank and somebody was on the bank's website, but then decided that they wanted to check out brokerage or some level of investment through the third-party channel, we would have to have not only roadblocks on the hyperlink and letting them know that they're leaving the site, but also, the one time per web session notification that they're leaving is also going to be a requirement. It also provides that insured depository institutions with additional flexibility for satisfying what we call the official signage and advertising statement requirements. So it does provide, I guess you could call it, some additional flexibility for the institution in satisfying those provisions in the current rule. It also requires the insured depository institutions establish and maintain written policies and procedures that are addressing the compliance part of the regulation 328, which is subsection, I believe, A and B, which must include appropriate provisions related to monitoring and evaluating activities of certain third parties that provide services. So the policy obviously is a pretty bold statement. Then you have your step action procedures that ensure that we're complying with the various components of the provisions. And in addition to that, the compliance, obviously, the procedures for Part 328, we also have to make sure that our procedures are clear relative to the monitoring on an ongoing basis to review not only our signage, our advertisements, so on and so forth, to make sure we're meeting the new requirements. So it's a little extensive.
What else is new?
Yeah.
Nobody said regulatory compliance was cheap.
Yeah.
Well, Dean, these are recent changes, and they are recent as we're recording this session today.
Yeah.
They are nevertheless very extensive, it sounds like.
Yeah, I mean, there is extensive. I mean, there's even more, and actually, I probably should extend or add to what the rule actually clarifies, because there are some additional clarifying provisions in there, and dealing with the FDIC's official advertising statement or FDIC associated terms or images in a manner that inaccurately states or implies that a person other than an insured depository institution is insured by the FDIC, unless the advertising statement is next to the name of one or more of the insured depository institutions. So again, transparency. They don't want you to, I always called it bait and switch, make somebody believe that it's an insured depository product when it actually isn't. Also, if a non-bank makes statements regarding deposit insurance for its customers, it is a material omission for the non-bank to fail to clearly and conspicuously disclose that it is not itself an FDIC insured institution, and that the deposit insurance coverage only protects against the failure of those insured depository institutions. Also, if a person makes statements regarding deposit insurance in the context that where deposits and non-deposit products are both offered on a website in close proximity, it is a material omission to fail to disclose that the non-products are not insured by the FDIC, are not deposits, and may lose value subject to certain exceptions. So again, I always use that good example of the investment side because those products are, again, not insured. And then lastly, if a person makes statements regarding, pass-through deposit insurance for its customer funds, it's a material omission if they fail to clearly and conspicuously disclose that, certain conditions must be satisfied for that pass-through deposit coverage to apply. So again, they're addressing those circumstances that where I always say where the commingling of products and services, both insured and not insured, are offered, and they want to make that clear distinction to folks that these are insured products and these are not insured products. So, that's I guess that's the bulk of all of the various changes within Section 328.
Now, Dean, you use the phrase "if a person makes statements." I assume you're referring to a representative of the institution, not the customer themselves, right?
Yeah, that's correct. Yeah. Yep. That's a correct statement. Again, we want to make sure that our folks are trained internally for these types of situations, we don't want to confuse. The other regulation, Len, I think of, and that comes to mind is when we've talked about it numerous times, is UDAP. And UDAP, I can see where UDAP will come into play here. It is a broad brush regulation, but essentially, for those folks that have advertising violations, you're most likely going to end up with a UDAP violation as well, because it could be unfair depending on what you say or how you say it. It could be, in certain cases, it could be deceptive in how it's applied, or I suppose it could be abusive too, depending on how the procedures and the policies are drafted within the institution, and of course how training unfolds. Well, again, I think the goal ultimately is exactly what they're saying in the regulation, and that is to make sure that banks are very clear to their customers that these are insured products, these are not insured products, and making sure that distinction is clear to all of them.
That's a great clarification, Dean. Now, I know you mentioned the effective date earlier of April 1st of 2024. Is there a difference between the effective date and the mandatory compliance date? And if so, what is the difference?
Yeah, that's an excellent question. And the answer is yes. Mandatory compliance was just recently actually amended. Originally, it was January 1st of 25, where they wanted everybody to be compliant. They moved that to May 1st. And I think some of that is a direct relation to some of the forms providers and being able to act fast enough to get these things modified and some of the disclosures modified. But yes, there is a difference. The effective date of the rule became effective in April of this year. And what that means is that we now have to be compliant with that and start putting those policies, procedures, and processes to comply with the new rule as of the effective date, which would be April 1st. But we're not required to be compliant fully in that implementation until May 1st of 25, and then that's when they'll start getting examined. So they should take steps ASAP to get that done if they haven't yet.
Yeah, don't wait to May of 2025 to start.
Yeah, that's for sure. Yeah.
That's when you want to make sure it's all done. So there's kind of a time to phase in, but there's no time to waste. People.
Exactly. Yeah.
Good. Now, is there anything else you want to share today about this topic, Dean?
Well, just one other thing. The final rule also does contain requirements for those insured depository institutions to establish written policies, procedures to facilitate compliance with those parts that I mentioned. When drafting, the institution should ensure that their step action, and what I mean by that is make sure first and foremost that the policy is not embedded in your procedure. Your procedure should be step action. If you go to Hawaii, you never come back, who can pick it up and know exactly what it is that in order to comply with those requirements. And you also have to, I always say context is important. The overall size of the institution, the complexity, the scope, and the potential risk. So, if you're an institution that doesn't offer a lot of those non-insured type products, then, perhaps your risk is mitigated and the steps for compliance are not as onerous. So again, take into account, the overall size, complexity, and scope of your operation before you start drafting these policies, procedures.
Yeah, and having things in writing, I'm talking about policies and procedures, is really a best practice, whether it's required or not. I deal with CRA and fair lending issues, and now Section 1071. And I've always told my clients, whether you have to have written policy or not, it's prudent to have everything in writing so that when, like you said, Dean, somebody takes off and goes to Hawaii or retires or whatever, they don't rely on oral tradition to pass on what's being done and how it's being done. So
Correct.
The fact that the FDIC itself is requiring, in this case, written policies and procedures, I think that's where the regulators are headed anyways for all regulations, not just this. So this is one of the first times they're actually requiring that. And I see it coming with regard to CRA and fair lending issues as well.
Yeah, I mean, it's like ordering anything online. I mean, you order it and you have to assemble it when it gets there. You certainly can't do it without the instructions, right? So
That's right. That's right.
that's where your policies and procedures certainly are really helpful in that regard. So
Yeah. Well, Dean, this has been another great and timely topic. And I want to thank you for the invaluable advice you gave and information you shared with today's listeners. This is Len Suzio with Geodata Vision.
And this is Dean Stockford from M&M Consulting saying thank you to our listeners for tuning in to today's discussion. And please let us know of any additional topics you'd like to hear in future episodes.
Thanks for listening to the Compliance 911 Show. If you like the podcast, be sure to subscribe so you don't miss an episode. While you're at it, please give us a like and review to help others find the show. As always, links are in the show notes, and you can always find us online at compliance911show.com. Follow M&M Consulting and Geodata Vision on LinkedIn for all the latest news and information on compliance hot topics.